Good morning, friends. Today we have a topic, our direct tax webinar series. Topic is transfer pricing, documentation and search process. We have our esteemed guest, CA Chaitanya Maheshwari ji. Let me introduce him. It's my proud privilege. Sir is practicing for more than 7 years in Mumbai and Indore. Work with following organization: ML Bhuwania and Company, Bansi Mehta, and IndusInd Bank. Sir, special contents is on transfer pricing, including TP advisory, audits, assessment, and study reports, compliance advisory, assessment in direct taxation, tax audits, and ICDS, other audits. Sir has handled many major assignments. Also have been faculty at various forums, including at ICI Tower BKC and many other forums. Tax Practitioner Association Indore, ICI branch Indore. Sir has in his credit ICI publication also on technical guide on income computation and disclosure standard. Research work done at many places for comparative analysis of change in format of tax audit report. Also, life member of Bombay Chartered Accountant Society. Pursued intensive study course on transfer pricing conducted by VCAS. And sir, various articles published at renowned professional website on various topics of direct taxation and transfer pricing. Sir is also a rank holder in his CA curriculum at the CPT level. Sir has worked around more than 18 industry as a part of his service provided. With this brief introduction, I would like to give chance, hand over charge to our speaker, Chaitanya Maheshwari ji. Sir, please continue.
Okay, thank you, Virag, for such introduction and giving me the privilege to present the topic of transfer pricing. I thank the organizing team along with you. So,
thank you, sir.
Good morning, everyone. Hope everyone is in safe zone in this time of crisis and be in safe zone till the crisis is over. Along with this, I just wanted to request if you can help the needy people around you, please do the needful, and however, keep the safety standards intact while doing the same. So now I'll start with our presentation, which is on basic transfer pricing documentation. It will start with the basics of transfer pricing provisions, and the documentation, mainly it will cover only the TP study report, what we normally used to prepare. So now I'll start. These are certain abbreviations which have been used into the hello, Virag.
Sir, audible, sir.
It's audible, but just let me know how to minimize this one.
What do you want to minimize, sir?
This window, or it will be there?
It will be there, sir. You just, you can minimize also, sir. There is a minimize option also there.
Okay. Yes. So these are certain abbreviations which have been used in the presentation PPT, and these are the contents. So we'll start with the basics of transfer pricing. What is TP? Why transfer pricing? Provisions under the Income Tax Act, charging section of the transfer pricing, that is section 92 under the Income Tax Act, associated enterprise definition, international transactions definition, specified domestic transaction definition, computation of ALP by and selecting the most appropriate method. By selecting the most appropriate method, methods of the transfer pricing, selection of most appropriate method, documentation, contents of TP study, which is the one of the major part of today's study, today's seminar. FAR analysis, comparable search process, what are the filters over there and how to conduct it, range concept under Rule 10 CA, and at last the provisions, penal provisions, if the documentation and certain compliance is not done by the assessor. So first, what is transfer pricing? So basically, transfer pricing is the transaction which has been done by the two associated enterprises, and such transaction is done at a transaction price which is called as controlled transaction, because they are in common parlance we can say related enterprises or related parties. However, I will use associated enterprises or AE, which is the better term and also being used by the Act. So this transaction is controlled transaction. So to counter this transaction, an uncontrolled transaction is analyzed, and it is analyzed in the context of Income Tax Act, so that it can be confirmed that no transfer of profit, business profit, has been done by one related AE to another AE which is residing in any tax-free zone or lower tax jurisdiction. Mainly, this was brought to counter the base erosion and profit shifting, we can say, which is the current burning issue across the globe. Suppose ABC holding company is there in country A. Suppose country A is USA. So it purchases certain product. It purchases certain product. Suppose it purchases a pen. ABC holding company purchases pen which is manufactured by ABC subsidiary company, and also it purchases this pen from XYZ, which is a non-associated enterprise of ABC holding company. So in this case, ABC holding company, if it purchases at lower rate compared to from a subsidiary, it's ABCS company, and compared to the XYZ purchase from XYZ, the Indian authorities will say that to control or to reduce the profitability of subsidiary company, so that it have the liability of income tax in the country A, country B would be lower. Country B would be lower. So the profit which should be taxed in India, country B, have been transferred to country A. So 100 rupees was the transaction price between country A holding company and subsidiary company, and 120 was the purchase price from XYZ. So 20 rupees profit was underestimated by company ABCS company, subsidiary company. So in this is a general transfer pricing example through which we can understand what is basic transfer pricing. Now we move to why this was introduced. So there were many multinational enterprises which have come to India, and this multinational enterprises have started their the erosion of profit from India to other lower jurisdiction countries like Mauritius or Cayman Island, and this companies have shifted their profits in a manner that they and planned their global tax liability in such a manner that once Apple reported 0.06% of global tax liability uh, into their books of account. So, and this was also done by this Starbucks and all the global M&Es. So to counter this, if in Finance Act 2001, Honorable Minister of Finance, Shri Yashwant Sinha ji, in his budget speech said the presence of multinational enterprises in India and their ability to allocate profits in different jurisdictions by controlling prices in intra-group transactions has made the issue of transfer pricing a matter of serious concern. I had set up an expert group in November 99 to examine the issues relating to transfer pricing. The report has been received proposing a detailed structure for transfer pricing legislation. Necessary legislative changes are being made in the finance bill based on these recommendations. So what we have understood in this slide, that multinational enterprises were siphoning off the profitability of their entities from India, where the actual economic activity was undertaken, and they were siphoning off to lower tax jurisdiction entities or no tax jurisdiction entities. Now next, provisions which are being there under the Income Tax Act are which the chapter 10 is the under the Income Tax Act covers mainly the transfer pricing, and except chapter 10 the section is 286 which is not covered under chapter 10, but it is also a part of transfer pricing regime. So it covers these all sections 92, 92A, and majority of them we will discuss in our next presentation slides. Now, charging section is section 92. Section 92 says any income arising from an international transaction shall be computed having regard to arm's length price. So I have bifurcated or this section 92. Again, I am showing this because any income arising from an international transaction. So what any income, we have to search for the definition of income. However, in this transfer pricing, it's not necessary there would always be an income, because if suppose there is an example of reimbursement of expenses which is not generating any income, it is pure without any markup, one AE of say of one country transfers it to other country. So in that case, AE into other country. So in that case, on cost to cost basis, if it transfers the same, it would be considered as income. It would not be considered as income. Still, that charging section 92 states any income arising from. So arising. So we have all we have all seen section 6 accrue or arise in India, section 9 and section 6 plus the charging section of income, that is section this arising, accrued or arising from India. So we have understood that this arising word in that context, but here also it is not necessary the income has arise. The transaction, if it's there between the AEs, international AEs, as well as the specified domestic transaction, then also this transfer pricing would be applicable. An international transaction. International transaction is defined in next slides, and we will discuss it in detail later. Shall be computed. So we have compute the pricing of the transaction having regard to arm's length price. So we will discuss the arm's length price. We have to calculate the arm's length price, and the actual transaction price has to be compared with the arm's length price to verify whether the transaction was at or around the arm's length price. I am saying around because there is 3% margin is acceptable except for wholesalers have been provided only 1% margin acceptance, 1% of differentiation from the arm's length price, and apart from wholesale business, the other transaction can be accepted if the difference is from arm's length price is 3% max, 3%. Next, A, section 92A. So we have in this charging section, one of the word was international transaction, the other is associated enterprise, which we have to understand if we want to go ahead for understanding the concepts of transfer pricing. Section 92A. A, in common parlance, as I earlier said, it is, we say, related party. But what are these related parties? In fact, AE's associated enterprise is an enterprise which participates directly or indirectly or through one or more intermediaries in the management or control or capital of the other enterprise. So all the examples of this control, capital management, participation in by one enterprise or into other, or some other, with some examples we will understand in the deemed associated enterprise, which is subsection 2 of 92A in later slides, in respect of which one or more persons who participate directly or indirectly or through one or more intermediaries, management, control or capital are the same persons who participate. This means common control, common management of two entities would also make them associated enterprises. So we come to next, subsection 2, deemed associated enterprises of section 92A. It has all described or prescribed deemed associated enterprises, that in these circumstances the parties would be considered as deemed associated enterprises, and this all the circumstances or cases would compulsorily be associated enterprises. So first is, and one entity holds up to more than or equal to 26% in other entity. So in this case, we can have example Indian holding company having subsidiary in US. So it's a holding company holding around 51%. So it would be the both of the entities would be considered as associated enterprises. This second, we will move, even if the Indian entity holds suppose 26% into the US entity, it would be, both of them would be considered as AEs, because it says 26% or more should be in other entity. Any person, entity or entity holds more than or equal to 26% in more than one entity. So this is common shareholding. One person holds shares of, suppose 26% shares of Indian entity and also 26% shares of US entity. They are not directly related, both the entities, but if one person holds such shareholding, both of those entities would be considered as A's. Loan by one entity is more than or equal to 50% of book value of total assets of the other entity. So suppose Indian entity has provided loan to US entity, and that loan, the total book value of assets of the Indian entity is is 100 crores, and loan provided by that Indian entity to US entity is suppose 60 crores. So this is 60% of total book value of assets, book value of total assets of the Indian entity. So in this case also both of the entities would be considered as associated enterprise. So if we go in previous slide, it says management, control or capital. So this can be categorized under control because the Indian entity is having control through loan into the US entity. Now, fourth is one entity guarantees 10% or more of the other entity. So, any loan amount is there. So, 60 crores, we can take example. If sorry, I cut off that example and new example I give. A UK based entities having loan of 60 crores and Indian entity is providing a guarantee to that UK based entity of say suppose 6 crores. So in that case also both of the entities would be considered as associated enterprises because 10% of 60 crores 6 crores and 10% or more guarantee value is guaranteed by Indian entity. Now we will go fifth one. 50% of more than 50%. Here we are. It's not equal to 50%. More than 50% of board of directors or governing board of members, or more than or equal to one executive director. मतलब एक executive director, if it is common, are appointed by the other executive member along with executive director or executive member of one entity appointed by the other entity. So Indian entity is there. It has an entity in there is an entity in Australia, no relation at all, but the board of directors, governing board members or executive directors or executive members are appointed by Indian entity into that Australian entity. Suppose the total directors are into the Australian entity are 10. So 6 directors are being appointed by Indian entity. Then in that case, both the entities would be AEs, or there are 2 executive directors in out of those 10, but only one executive director if is appointed by Indian entity, it would be considered as associated enterprise. Or executive member can be a CEO, CFO, even though he is not the director. If even one executive member is appointed by Indian entity, then both the entities would be considered as AEs. Now 50% of the board of directors or governing body or more than one executive director or executive member appointed by same persons. Now earlier point was one entity is appointing into the other entity. Now a common person is there who is appointing the directors, board of directors or executive directors or any executive member into both the two or more companies or corporates across the globe, but there is no other relation. If that is been documented or satisfied, then also the enterprises are deemed associated enterprises. Now 7 point, manufacture of goods or business wholly dependent on know-how, patents, copyrights, trademarks, licenses. Suppose a patent has been developed or by a US entity, Indian entity on that patent or formula, we can say formula has been patented of any medicine, and on that basis Indian entity is manufacturing that medicine and selling to across the globe. If in such a case, if the Indian entity is wholly dependent on that patent, Suppose if the patent is taken back by the US entity, and in that case, if the company is unable to manufacture any such medicine, then that would be considered, or any other medicine, because it says manufacture of goods or business wholly dependent. If it is justified, or it is satisfied that it's not wholly dependent, then we can argue that this clause would not be applicable, and both of these entities would not be considered as deemed associated enterprises. So this is one of the arguable. This can be argued, or it is arguable matter. Now, next is if more than or equal to 90% of raw material or consumable supplied by other entity or by person specified by other entity and influence the price and other conditions of such price. So if those two entities are there, suppose an entity is there in South Africa, other entity is in India. So South African entity supplies raw material to Indian entity for the manufacturing. Suppose 100% raw material is being supplied by that entity. There is no connection and no other connection with that between those two entities. Then both of their entities, those entities would be considered as associated enterprise. In this, we have another uh, part in this clause, that is, or by person specified by the other entity and influence the price and other conditions of purchase. Suppose even person specified by other entity specifies that I will supply 50% of the raw material, but remaining supply you have to purchase from this entity. South African entity says you have to purchase from Canadian entity. So Indian entity, and the price is also influenced. In this case, normally in such agreements or arrangements, prices influence, and if we aggregate all whole both of the raw material, then it would be more than 90%. The conditions and of purchase of such raw material are being uh, put up by South African entity in our example. These two have to be satisfied. That is, it has specified that you have to purchase from the Canadian entity to, and also the conditions of terms and conditions of purchase along with pricing is also controlled by that South African entity. In that case, uh, both those entities would be considered as associated enterprise of the Indian entity. The goods manufactured by one entity sold to other enterprise or person specified by other enterprise, and the prices and other conditions relating influenced by such enterprise. So in this, goods are manufactured by one entity, sold to other enterprise or persons specified by other enterprise, and the prices and other conditions relating to are influenced by other enterprise. This is similar to what uh, we have understand in eighth point, but it is sale. It is on sales side, specified by other enterprise, and the prices and other conditions relating. So I'll move to next one. When one enterprise controlled by individual and other enterprise is also controlled by such individual or his relative, or jointly by such individual and relative of such individual. Suppose now we were discussing regarding companies. Now we come to other constitution of business, that is say partnership firm. So a partnership firm is in India, and there one partnership firm is in Dubai. So both are having common partners. Suppose there is only one common partner, then both the enterprises would be AEs, associated enterprises. And now in this, another example we'll take. A partner is there in Indian partnership firm and having his brother as partner in Dubai partnership firm. So here relative is also covered. So that means both of those entities in this scenario also would be AEs. When one enterprise is controlled by HUF and the other enterprise is controlled by member of such HUF or by relative of such member. So this is also similar to what 10th point is there, earlier clause, but this is in relation to HUF. So HUF is controlling the enterprise and its member is controlling other enterprise, or the relative of member is controlling the other enterprise. Both of those enterprises being in different jurisdiction, tax jurisdiction, they would be considered as associated enterprise. When one enterprise is firm, AOP or BOI, and the other enterprise holds so more than 10% interest in such firm, AOP or BOI. So if firm AOP or BOI is there and in and any interest is being held by any other firm AOP or BOI in that AOP firm or BOI more than 10%. So here the more than 10% is the crux, because everywhere there is the percentage is varying, and here only 10%. If there is interest of only more than 10%, not equal to 10%, then also the relationship of AE is satisfied, and there exists between the two enterprises uh, any relationship of mutual interest as may be prescribed. So via this clause, the government has been provided power to define any other relationship to be as associated enterprise through any through which the government can prescribe in the rules. International transaction. This is also very important definition to be understood for understanding the transfer pricing concept. It says transaction between two or more AEs, either or both of whom are non-residents in the nature of purchase, sale, or lease of tangible or intangible property, or provision of services, or lending or borrowing of money, or any other transaction having a bearing on profits, income, losses, or assets, and shall include a mutual agreement or arrangement between two or more AEs for the allocation or apportionment of any contribution or any cost or expense incurred or to be incurred in connection with the benefit. So I'll just break all the clauses in this and explain transactions between two or more AEs. So there should be two associated enterprises. So either or both of whom are non-residents. Out of both of those associated enterprises, one should be non-resident. At least one should be non-resident, and the transaction should be in nature of these 5 types of transactions, so which are normal purchase, sale, lease of tangible as well as intangible property, services, provision of services, lending of borrowing or borrowing of money. This also includes guarantee and any type of loan provided by one entity to other entity being associated enterprises, long term, short term guarantee, any type of guarantee it covers, and certain bonds or securities if an entity has invested into the such securities of other entity being AEs. And now the residuary clauses, point D, any other transaction having a bearing on the profits, income, losses, or assets of such enterprises. Now, reading this clause, I would just want to ask you all that whether dividend paid by subsidiary, Indian subsidiary to suppose its UK subsidiary being considered as international transaction or not. So at last of this end of this presentation, we'll discuss whether it would be considered as an international transaction. And last E clause is that shall include a mutual agreement or arrangement. Suppose this I'll explain with the example that an entity group of companies, multinational and enterprises are there. So we can take example of Videocon, uh, or we can say Facebook is much better example. Facebook, if we take Facebook India, so Facebook India is one entity which is providing a back office transaction or support to its entities in suppose Asia Pacific region. What are these services it is providing? It is providing IT support, it is providing HR support, it is providing payment support, payments operations. Suppose three types of these arrangements are there, and all the Asia Pacific countries where Facebook is having its group entities are taking these services from this Indian Facebook entity. So Indian Facebook is providing this services and charging certain amount from all the entities to whom such services are provided. So this is an arrangement, and there is if they enter into agreement, then that would be considered as mutual agreement or arrangement. And this e clause is defining such type of transactions to be as uh, international transaction. So now next is international transaction, deemed international transaction. So I'll just explain in brief this deemed international transaction. There are two entities, but they are not associated enterprises, correct? An entity, Facebook. So in this example, we can uh, have a Google entity is there in US, a Facebook entity is there in UK. These two are not related entities, they are not AEs. Transaction by an enterprise with a person other than an AE shall be deemed to be an international transaction entered into between two AEs. There is a prior agreement in relation to relevant transaction between such person and the AE of the assessee. So Indian entity is there. Suppose Amazon India. So there are three entities in example: US, UK, and Indian. All three are and US and Indian entity are AEs. However, US entity tells you Indian entity for certain type of arrangement or agreement uh, that such transaction would be undertaken only with the UK entity by the Indian entity, and Indian entity cannot enter into take such services from any other entity globally. So arrangement has uh, this arrangement has been termed as the any transaction. The AEs deemed AE we have already uh, understood, and now this is deemed international transaction. So any transaction if undertaken by Indian entity and UK entity would be considered as deemed international transaction, though they are not an associated enterprises. International transaction. So this international transaction, this is transaction between two or more AEs. So this is the circumstances which have been defined in 92B first subsection, and here the international transaction has been extended with inclusive definition, which says it includes purchase, sale, transfer, lease, or use of tangible property, purchase, sale, transfer, lease, or use of intangible property. हमारे intangible assets, no patents, know-how, copyrights, etc. Capital financing, including any type of long-term, short-term borrowing, lending, or guarantee, etc. Provision of services. There are various types of services they have defined in this definition. And transaction of business restructuring or reorganization entered into by an enterprise with an AE, irrespective of the fact that it has bearing on the profit, income, loss, or assets. So this transaction, if even if it was not having any bearing on profit, income, loss, or assets of such enterprise. This is also come under the purview of international transaction. There is live example we have recently come across in one of our clients. That the client was a company based in US and having a branch in India. It was operating through the branch, which was a permanent establishment into India. Now that permanent establishment has transferred its whole business to newly incorporated company of that group, and being permanent establishment and the newly incorporated company were having both the residents, but being branch of US entity, that permanent establishment was that branch or UK entity is non-resident. So when this condition is satisfied, either or both of whom are non-resident, and the business transaction has been considered as international transaction via this clause under this definition. So that means that is an transaction between AEs and international transaction under 92B. Intangible property has also been defined under 92B, which includes marketing, technology, artistic, data processing, engineering, uh, customer database, contracts, various intangible contracts, human capital, location, like location savings in China or India was earlier considered as intangible property. Uh, Many entities, US or UK based multinational enterprises have their back offices in India. So location is considered as intangible. Goodwill, and there are various case laws regarding this in transfer pricing, which says location savings are also the in, are also international transactions and should be added to the income of the assessee. Goodwill, methods, program, system, procedures, campaigns, surveys, etc. And last is any similar items that derives its value from its intellectual content. So this is a residuary clause. Now we will come to, we have understood in AE, international transaction. Now within a tax jurisdiction, there are specified domestic transactions where tax can be planned in a way that it can be shifted from taxable zone to tax-free zone, like SEZs. So in that case, also the government has introduced, the parliament has introduced section 92BA White Finance Act um, in terms of SDT, specified domestic transaction. Now I'll just provide you the crux of this, that an entity is there in, say, tax jurisdiction, uh, normal tax jurisdiction, and there is a tax-free zone, SEZ, in Mumbai, and we can say SEEBS is an SEZ, and the entities, there are two entities of the same group. One entity is into SEEBS and other entity is operating into tax-free zone, say into South Mumbai, Nariman Point. So these two entities are being operating, and if there is a transaction between both of these entities, the SEEBS entity and taxable zone, Nariman Point is this entity at Nariman Point. So both of that transaction would be considered as specified domestic transaction. There is a chance of transferring the goods or services at lower rate or higher rate by lower or higher rate, as the case may be. If the transfer is from taxable zone, it can be charged at lower rate compared to market rate or arm's length price, and if it is charged by SEZ, it can be charged at a higher rate. So in this case, there is a arbitration available with the assessee, and he can play with such tax arbitration. So to avoid or to curb this, section 92BA has been introduced, so that such transactions are being covered under the purview of transfer pricing. So now, in the recent ordinance of income tax, which has amended the Income Tax Act, it has introduced Section 115 BAB, which is about companies, incorporate companies into manufacturing would have 15% of tax rate. So normal companies, if they transact with such companies, and if they are associated enterprise, then they would be considered, there would be a chance of tax arbitration in this. And so these companies have also been covered under the transfer pricing regime, so that the transaction should are done at arm's length price, and cannot be the profit cannot be transferred uh, from taxable zone to tax-free zone unnecessarily. Now, all the such transactions, if they are more than rupees 20 crores in that previous year, then only the specified domestic transaction would be applicable. That means domestic transfer pricing would be applicable to the entities into the transaction. So there is a limit prescribed for domestic transfer pricing. That is, the SDTs or specified domestic transaction must be more than rupees 20 crores in the previous year. Now, computation of ALP. Computation of ALP by most appropriate method. So, arm's length price, we were discussing various at various points. What is arm's length price? Which is applied or proposed to be applied in a transaction between persons other than A's in uncontrolled conditions. So that means if there are two unrelated parties, then any transaction between those two unrelated parties, that is non-associated enterprises, would probably be uncontrolled price, would be at uncontrolled price, correct? So in this, they cannot control the price or profitability which is associated with that transaction. So because the seller would say, I will sell at this rate only, and buyer would say, I will purchase at this rate, and they will come to a point if there is negotiation, or if there is an agreement. So that uncontrolled transaction is a market price in common parlance. Now, ALP in relation to international transaction or specified domestic transaction can be determined by using the methods which have been prescribed under section 92C subsection 1. There has been 6 methods prescribed, and they have been defined in rule 10B sub rule 1. So there are 6 methods: cup method, RPM, resale price method, cost plus method, TSM profit split method, TNMM transaction net margin method, and at last any other method, such other method as may be prescribed. Or if not prescribed, we can, if all the above 5 methods are not applicable, and we can justify using the and any other method, the arm's length price of the transaction, then that can be used. Now, methods. I'll just brief up all the methods, how and when generally they are used and they are applied. So this is first, cup method. Cup method is the most acceptable method. If the applicability of cup method is justified, the authorities accept the method, and generally they accept the cup method, or globally it is accepted as the most reliable method, correct? So in this, what is the crux of this cup method? comparable uncontrolled price method. As the name itself says, the uh, pricing, the international transaction or SDT are compared to comparable uncontrolled price or a comparable uncontrolled transaction. Such transactions are compared to comparable uncontrolled transactions. See, in short, it's called cut. So if in there is transaction between two AEs, an AE of India and AE of US, uh, and Indian AE also say purchase of raw material is the transaction. It also purchases that raw material from another US entity, and that uh, that is not an AE, that is non-associated enterprise. Now the same raw material has been purchased same uh, from same tax jurisdiction, that is US, and uh, now we have to compare the rates. If these two are perfect, then rate we will come to the rate what the rate has been applied in both the transaction. It has purchased from US entity non AE as well as AE Indian entity has purchased raw material. So this is to be if the transaction price is similar or same to that transaction with non-AE, then it would be considered as arm's length transaction. So people might be thinking that yes, this is very easy and all, but it's not at all, because cup method is not the widely used method, and there are various reasons for this, because in cup method we have to compare apple with an apple, not apple with a mango or apple with any other fruit. That means all the conditions must be similar in comparing both the transactions vis-a-vis this with AEs as well as non-AEs. Then only we can compare both the transactions. Next is resale price method. Resale price method is a method where we use to compare the gross profit margin. Gross profit margin, that is in resale price method, the assessee purchases a product from its A and resale to uh, non-A's, and also it purchases product from non-A's and resell it to the non-A's. So in this we have to see the purchase from A compared to purchase from non-A. Normally this method is normally you can be used into traders. also able to see?
हाँ यस सर आ रहा है आपका कैमरा खाली आई थिंक नहीं आ रहा है
I've clicked. अभी आ रहा है कैमरा?
परफेक्ट हो गया हाँ कंटिन्यू प्लीज कंटिन्यू
Everything is first. So I was where it got stopped. Hello Virag.
हुआ 2 मिनट के पहले का वापस ये कप मेथड हो गया था उसके पहले से
Voice
मतलब
नहीं
एक
आ रहा.
बार 2-3 मिनट का रिवाइज करवा लीजिए सर प्लीज
Hello. Wait. साइलेंट पे कर देना. 1+. हेलो विराग.
हाँ सर मैं सुन रहा हूँ बताइए
अच्छा I got ये where this webinar got stopped.
ये रिटेल वाले से स्टार्ट कर दीजिए सर प्लीज
ठीक है. RPM. So there was some technical problem. I'll start with the RPM. With this I was
कप मेथड भी कर दीजिए रिवाइज क्वेश्चन में आ रहा है सर थोड़ा सा वापस एक बार रिवाइज कीजिए कप मेथड आल्सो
cup method. Okay. So I'll come to cup method. Cup method was is just comparison with the uncomparable uncontrolled transaction. The name it's of cup method itself suggests what it is, comparable uncontrolled price method. So if there is an international transaction or specified domestic transaction, and with these are normally within they are with our AEs, and if there is the same type of transaction with the non-A's and there are similar or same circumstances, exactly same circumstances, then we have to compare the price of international transaction with that uh, price with the non-A's. That is also called comparable uncontrolled transaction because both the parties are not related or not associated, so they are termed as non-A's, and the transaction is uncontrolled transaction, but which can be compared to the international transaction or SDT. Correct. So if there is transaction by one enterprise, say Indian entity, with the US entity, I was giving the example of this example, and with AE as well as same transaction purchase of raw material from non-AE from which is also based in US. So we can compare in this case the transaction of from and non-AE if the transaction is within the same compared to non-AE, then that would be considered as arm's length price between the associated enterprises, and there would be no addition. But here the cup method is can be applied only when there is the exactly similar circumstances, exactly same in fact circumstances, like purchase of raw material, same type of raw material. There is no difference in the physical characteristics of the raw material, which have been purchased from UAE as well as non-UAE both. They are being, if suppose in this case a non-AE has been situated in UK. UK is altogether a different tax jurisdiction. So this method cannot be applied because there are two types of jurisdiction involved, even though the raw material purchased is the same. Okay, so this in cup method we have to always compare apple with an apple and cannot be compared apple with any other fruit. This is a metaphor which is defining the methods of transfer pricing to determine ALP rules. So rules 10b, rule 10b, sub rule 1, clause B defines resale price method. So I was telling that in resale price method, it is to be seen from purchase side, not sale side. That is purchase of product as well as purchase of services from A and sold to non. Have to calculate the margin earned on this transaction, and this margin has to be compared with the purchase from non-A's and sold to non-A's, purchase of product or services from non-A's sold to non-A's, and this is normally used when in trading business, because there is a gross margin to be calculated or compared, and processing of raw material, and only trading in trading activity or very less. Wait just a second. Hello
सर ये कैमरा बंद कर दीजिए, ऑडियो बहुत क्रैक हो रहा है.
अच्छा अभी कर देता हूँ कैमरा. So everyone is able to hear, I think. Correct, Virag? Hello.
Please continue now. Now voice is better.
Yeah. So in this methods of TP, RPM, resale price method. So the margin of raw material, or sorry, in fact, product purchased from A has to be compared and with the margin of products or services purchased from non-A, and that those margins, if they are same at par, then that those will be considered as the transaction with AE would be considered as ALP. So this is in this we have to calculate the gross profit margin and compare between the purchases of products or services from AE and so resold, resale, and from non-AE and resale. Correct. And normally this rule, this method is applicable in cases of trading activities. Cost plus method. This method is normally used in cases of manufacturing activities or further processing activities. Or so half of the material has been processed by one entity, other part is manufactured or processed by other entity, and third entity is doing the finalization stage. So this cost plus method is the comparison. In this we have to compare the gross profit margin when we sell to normal when we sell. This is from sales side, correct? Our last method was from purchase side. This is to be seen from sales side. This is the product or service has been sold to A, and what gross profit we have marked up, that gross profit markup we have applied with to A or charged to A, compared to gross profit markup with respect to cost charged to non-A. These two have to compare and analyzed in this situation, but the product should be same. Correct. Product should be same. Now profit split method. This method is very rarely used, but bigger enterprises, multinationals have used in fact such method. The profit split method is there is a transaction which has been undertaken by uh, entities, more than one entity of the group, correct? And the profit is being earned by all of them jointly, not separately. They have earned the profit in those transactions jointly. So in this, as a very simple example, we can take an assignment of transport of products, business products, was uh, received by US entity of a group into the logistics business, and it has to be transported to India. So it contacts Indian entity. Both the entities are involved. One entity one entity is doing uh, transport, sending the product from US. Other entity is receiving the product. That is, one entity is collecting the products from their clients or customers and arranging to send them to India, and Indian entity is receiving and sending to the address where it is to be delivered. So in this transaction, those two entities of the same group are involved. Suppose number of people in US, they were 100, sorry, 10, and 12 people were engaged, 12 employees were engaged in India for the same. And the profit they have earned in this transaction, net profit after cutting all the costs and from the revenue, is rupees 220. So now we can divide this profit between Indian entity and US entity on the basis of number of headcounts or number of employees engaged into executing that transaction. So 100 rupees would be allocated to US entity as a profit of profit, and 120 rupees would be allocated. This is in the ratio of the execution of this transaction, 10 employees of US entity and 12 employees of Indian entity. Example, and normally it is not used. The rarest usage of amongst all the methods is PSM. So this is and it's normally used while transaction of any intangible or some related to intangible property. It can be used normally. Now, after PSM, the residuary method, two residuary methods, we can say T and MM. If all the above methods are not applicable, we will switch to T and MM, correct? So T and MM says we have to compare. In this, we can compare apple with mango. In this, we can compare apple with watermelon, any other fruit. So uh, this method only says to compare the profitability, that is profit margins, and in technical terms we call them profit level indicator, PLI. That profit margin can be operating profit margin with respect to operating revenue, operating profit margin with respect to operating cost, and gross profit margin with respect to um, gross revenue. So these can be compared among the entities, and we can analyze the transaction whether it's at arm's length or not. Now this is the most commonly used, and also like cup method, if this also justified, it can be accepted. And even in our what we say tax jurisdiction, India, in Indian authorities, if even we justify our transaction at ALP by cup method, uh, while assessments, the transfer pricing officer TPO uh, also tells or us to conduct the search process and apply TNMM. So they apply it conservatively, even though we justify 100% of our transactions, international as well as domestic SDTs, through cup method. Then also they normally they force us to apply this method, so because they think from point of view of uh, revenue. So this is this cannot be changed. TNMM. So in this, the comparison of is of margins. So where from we would compare from? We would compare from publicly available data. In this, they have though the method is divided into two sub methods: internal TNMM, external TNMM. But normally external TNMM and TNMM is applied for getting the results. Correct. And that too using the publicly available data databases. In fact, there are three softwares which are through which the Indian authorities accept the data, of which the data is accepted by Indian authorities. The three softwares are Capitaline, uh, ASTP, and third is ProS. So all these three databases are uh, acceptable by Indian authorities. Uh, During the assessments, we have faced such. We have also introduced or some concept that we take the competitors list from the uh, our client, and we extract their financial information from ROC website, MCA website, and analyze their profitability also, and compare our profitability of our assessee with that assessee, with those entities. So, but those such type of entities are not acceptable by the authorities. Accepted by the authorities, they directly only accept the databases and authenticated databases as per the CBDT, which are these three. Now, last method is again residuary. If any of the method is not applicable, cannot be applied, this method, if which can justify the transaction, this method is applied. A common example in of this method applicability is investment of uh, holding company, Indian holding into US holding, US subsidiary. Suppose it only holds 51%. Now it wants to increase to 70%. So 19% is again invested into that in US entity by Indian entity. And in that previous year, that investment of such 19%, increment of such 19% into the shareholding of US entity would be considered as the international transaction. And if we can apply this method as because it is it is not affecting any profitability of the both the entities. It's mainly capital contribution. And the same if it's suppose it has been invested at par, no premium, the shares were of that entity have been issued at par and no premium was charged. So this is simple transaction, and all the regulations of RBI under FEMA and income tax and regulations applicable into US have been applied um, properly, appropriately, and the transaction was undertaken. So this is an example of application of any other method that has been prescribed under Rule 10AB of the rules. Selection of most appropriate method, Rule 10C. Now in this, I'll just read out how to apply most appropriate method, uh, or how to select the most appropriate methods out of these 6 methods. these are general factors on the basis of which we have to select most appropriate method, the nature and class of international transaction or SDT, class or classes of AEs entering into such transaction, and the FAR analysis, very important part of our DP documentation, availability, coverage, and reliability of data of in relation to the transactions, international transaction as well as transaction with non-AEs, degree of comparability, how much we can compare apple to apple is there, or some other method, if or we have there is a variability between the comparable transactions, and extent to which reliable and accurate adjustments, how much we can adjust the comparable transactions with respect to international transaction or vice versa, and nature, extent, and reliability of assumptions, the assumptions, how much we can rely or apply the assumptions. So this we will see in our live, or we can say in a search process, which we'll discuss in later in this slide, in this presentation. Every person who has entered into an international transaction, now this is the documentation. Documentation has been mainly prescribed under section 92D and read with section rule 10D. Now here we are today discussing only the documentation related to transfer pricing study report, and not other documentation which have been recently introduced into the Income Tax Act in as master file documentation and country by country reporting. So these two are will take another presentation, because they are altogether in-depth documentation and to be discussed separately. So these are certain matters or should be included in our description. So documentation. What are the contents, or we can say contents should be included into the documentation, the transfer pricing study report. In short, I'm referring that to as documentation. Description of the ownership of the structure of assessee, profile of multinational group of which the assessee enterprise is a part, description of business of assessee as well as the AEs with which it has transacted, nature and terms of the international transaction or SDTs, or along with the details of property or services and quantum and value. FAR analysis, important, economic and market analysis, any forecast, budgets, etc. Is there. Record of uncontrolled transactions, cuts taken into account, record of any analysis performed, and all the documentation which are the basis of our analysis to conclude that the method which is applied is most appropriate method, and description of the methods considered as most appropriate method we apply. Normally in our documentation we apply every method and justify whether it is applicable in the situation or not applicable on the basis of documentation, information, and circumstances at that time. Documentation read this it contains the limit. That means in case of international transaction, if the international transaction is up to ₹1 crore, so this detailed documentation is not required to be prepared by the assessee, which is we have discussed. It just have to maintain those documentation which can substantiate that the said transaction has been entered at ALP, and the method applied is the most appropriate method. And second, for SDT, study report is mandatory, because SDT's limit is already prescribed, that is 20 crores or more. Study report applicable all straight away when SDT is applicable. Master file. Now These are the contents of study report: introduction, objective of the document, scope of the document, description of the group and company. We have already discussed in earlier slide. This is a synopsis of the study report. Industry overview and industry analysis, which can contain introduction of the industry, global or in domestic scenario, growth drivers, factors impacting the industry, SWOT analysis, and any other relevant point. TP regulations under the Act are also mentioned in the study report. What are the regulations under the Income Tax Act? Applicability of TP regulations, how the TP regulation is applicable to the assessee, identifying AEs and international transactions or SDTs entered with the AEs. Functional assets and risk analysis. This is very important part, and we will discuss it later. Determination of most appropriate method transaction wise. So as I have explained earlier, we have to apply every method and justify whether it is applicable or not in so on every transaction, international transaction and specific domestic transaction. We have to apply every method and justify whether it's applicable or why it's applicable, and if it's not applicable, why it's not applicable. Correct. And then finalize in the most appropriate method which is applied. Comparable search process, selection of tested party. Comparable search process, we are going to discuss it so in later slides. Selection of tested party, selection of appropriate PLI, process of comparable company search, and applicability of range concept under Rule 10C, justifying applicability of method, and conclusion of the search process. Checklist of documentation is to be provided into that document, TP study, which is we have discussed in Rule 10D. Attachment of the required documents, relevant attachments like the invoices of the comparable and controlled transaction and international transaction or SDT, service agreements, any agreements or purchase or sale agreements or royalty agreements entered between the AEs, third party quotations if they are, we have taken any third party quotations, some relevant screenshots, or if we want to justify our transaction at ALP from certain screenshots of say interest rates from SBI or RBI and interest rate, then such relevant screenshots we can take up. Now FAR analysis, as I've discussed in detail, here I'm discussing function, perform, manufacturing or trading. We have to provide this FAR analysis into the TP study report, and this is the most important part. And post BEPS action plan coming into play, they are now of utmost importance because these will play a very important role. This FAR analysis will play a very important role to determine the profitability, allocation of profitability between the A's. So now I'll just in summarized way discuss the points of functions performed, assets employed, and risks assumed by the associated enterprises in entering into the international transaction or SDT. So FA functions can be manufacturing or trading, which company is manufacturing, which company is trading, or which company is providing marketing function. We can analyze that. Product development, any company doing product development or R&D. Marketing functions can be segregated into normal marketing, any negotiation with the client, any MOU or service level agreements, which entities are performing these tasks among the group. Service functions like planning, development, manufacturing or manufacturing schedules, planning, development schedules or manufacturing schedules, assuring quality for clients, training personnel, personal or human resource training, and developing their training material. These are the functions related to service functions, along with the common service provider of the group, which entity is providing common services like back office work, accounting services, etc. After sales functions, warranty and customer support, these functions are handled by which associated enterprises. Handling complaints, which company handles the complaints. Accounting functions like processing orders, recording their progress, and handling billing and collections. These are illustrative, as much as I could have done. I have made them illustrative, and there can be more functions added to it. Now, next is assets employed. Assets employed are employees or human resources which company they are further segregated. Manufacturing personnel are uh, of employed by which entity, associated entity. Marketing personnel, after sales personnel, any service providers, property, plant and equipment. Plant and machinery, in this it is further segregated into plant and machinery, office premises, storage or warehouse premises, which entity is owning all such fixed assets or plant property, plant, equipment. Intangibles, brand, trade name, distribution network, processes, technical know-how, and any other intangible property. Which entity is owning intangible, like take example of Google. So the Google logo is being owned by US entity globally. So that the name of it has developed, the brand name is with the US entity. Inventory, spare parts and consumables, who all entities take care of all such inventory, normal inventory, spare parts, consumables, and cash flows. Who takes care of cash flows, which entities within the group takes care of such assets. Next is risk assumed. Litigation risk. Any litigation if come up, that risk is taken care by holding company or subsidiary company in other country. Or calamity risk, further segregated into natural and man-made. So natural, earthquake, floods, fire, and currently we are facing this COVID-19 calamity, and man-made. In fact, I don't know whether it's natural or man-made. So if still I have kept it in natural factors. Man-made factors like wars, etc., acts of public enmity, riots, strikes, lockouts. Now business risk. So above risks are uh, other risk than business risk, and the business risk can be forex exchange, who will take care of in case forex fluctuation is there. Market risk, market and product quality risk, inventory acquisition risk, capacity utilization risk. If capacity goes down of the manufacturing entity, what would be the who would take that risk? Credit risk of clients if we are unable to recover any receivable. Working capital risk, human capital risk, technology risk, and regulation compliance risk. Compliance risk is also associated with every entity in their own jurisdiction. So these all risks have to be segregated among the group entities which have undertaken the transaction, the A's which have undertaken the transaction. Now, comparable search process. We start with the comparable search process. And hello, Virag. I'll just hello. I think we have 15 minutes more, and I'll go through the comparable search process.
Yes, Chaitanya ji, please continue. है हमारे पास time.
We have how much time? Still,
We have sufficient time. You can take.
15-20 minutes I'll take.
Yes.
Okay. Comparable
Yes.
search process is the major portion of our today's seminar, one of the major portion. So we start with selection of tested entity. So it's not necessary that tested entity, first of all, what is tested entity? The tested entity is entity which would be the profitability of which would be compared to the external comparable entities. And in this case, assessee normally is the tested entity, but it's not necessary that it always be a tested entity. Suppose there is a uh, group having a holding company in US and two subsidiaries in India. So both the entities, they have transacted with that US entity uh, with in the previous year. Within that previous year, they have transacted. Both of those entities have transacted. Now, US entity also files a return of income into India, and uh, all the other Indian entities also file. It also have to file the transfer pricing audit report. So for justifying the transaction at arm's length price, we need to conduct a search process, comparable search process. Now in larger MNCs, it's not possible to get the financial statements of holding companies. Like in our example, US entity is not willing to share the financial statements. So in this case, our both the Indian entities can have to be taken as tested entity, and their profitability have to be seen. If their profitability lies within the range, then it would be concluded that the transaction is entered into at ALP, arm's length price. So basic criteria is entity performing simple functions. The most simple entity within the group is taken as a tested entity. Like trading is simple activity than manufacturing. So trading entity would be considered as simple or a tested entity. But however, this cannot be applied in various circumstances or cases. So generally, we take the entities having the comparable data easily available in the public domain. So we apply in our case of that US entity having two subsidiaries, the publicly available data of those two Indian entities is also easily available, even though the US entity supplies its financial statements or shares its financial statements to with us. How we would be able to compare the Indian comparable entities which is available in public domain, and we are unable to and the with the entity in US, because both the jurisdiction are having different economy and different tax jurisdictions having different market conditions, though they cannot be compared. So here we have taken those two entities as the tested entities and applied the search process to get the uh, comparable entities. Next is we have to select the profit level indicator. Normally there are few factors. Profit level indicator, I have discussed it earlier, that the basis, the profitability margins which are to be compared, what margins which can have to be compared, and when there are few factors on which the selection of PLI is dependent. Nature of activity of tested party, reliability of the available financial data, extent of PLI is applicability to this data, PLI applicability to the data available. So these are certain factors, and general PLIs are operating profit to operating cost, which is also taken by the CBDT when it prescribed safe harbor rules, and operating profit to operating revenue or operating income is also commonly used profit level indicator. So operating cost is specifically normally used in manufacturing entities, and operating profit to operating revenue is normally used in trading activities or services activities, because manufacturing cost is the main uh, element, um, And in trading or service activities, revenue is the main or basic element on which profitability is dependent. And certain cases we can use gross profit ratio. Uh, Now, process of comparable search process. Uh, so comparable search is having general filters. We have to apply general filters. So this, after selecting the tested entity profit level indicator, we have to start the search process. Search process is started uh, with the selection of companies from the basic database, that is industry wide, as well as NIC activities. So software also extract the NIC activities. First of all, let me explain NIC activities. NIC stands for National Informatics Center, uh, and this center, that is government itself, has defined the various companies into further product wise categorization, in fact. So this is also a broader categorization, and further in-depth product wise categorization is also there, which the companies normally share in their financial statements, and the databases which we have, the software companies of those databases supplies those information to us through their software. So this, on the basis of industry and NIC activities, we will select those industry or NIC active companies which are dealing into that industry or NIC activities, and such industry or NIC activities in which the tested entity is operating. Now, this I will explain side by side through examples. I'll take only the agro trading in agro products. Correct. I'll take the example of this entity trading in agro products. Search process we have conducted, and after selecting all these companies into the industrial and NIC activities which are matching with the tested entity, we will select the latest available data. That is, suppose we are preparing for assessment year 2021. So entities having their financial statements ending on March 31st, 2020 would be taken, or if that data is not available, the entities or comparable companies having data of earlier previous year. Earlier previous year is 31st March 2019 ending. So either this year or earlier previous year, not not earlier than that. So these 2 years, this is as per rule 10CA, it has given. Earlier the search process was conducted only taking latest data available. So we have conducted a search process. This is a basic documentation, selection of tested party, process of comparable search process, and these are the entities. Agro products trading, entity into agro trading. So see, our TNMM is very conservative approach we have to apply in TNMM. So if it's into similar business of a tested entity, or having the industry is covering that entity and covering all other entity, like trading, we have taken trading. Agro based industry was not there in the database, so we selected trading, or trading large, trading medium, small as the category as categorized in that database, and these are the industries we have selected. These all on conservative basis, because these may include the trading agro trading entities may include. So where there is a even 1% possibility that such category would include may include agro trading or business similar, not exactly same. It is similar to a tested entity. We have to take to apply the TNMM. NIC activities, we have taken all these NIC activities, agricultural, other agricultural, and also we have taken cattle feed and trading also we have taken all together. See here, we are we have selected first these industries, and they have already included majority of companies which are dealing into such NIC activities now, which are left. They have been selected using this NIC activity categorization, and this is the newer NIC categorization, NIC 2008, available by the government of India. So total companies which were selected trading in is 8950. So we got 8950, but we total companies were 8950, but the data was available of only 2538 in the database. So we got 2538, see here in this column, 2538 companies as comparable. Now we have to make next filter. Next filter we are applying the turnover filter. The entity was having the turnover of 823 crores in that previous year, in the concerned previous year. Sorry, next filter is this what I have explained, 2007. This we are conducting for assessment year 17-18. So for March 31 2017, the data was available of these much entities. I'll just filter it up. These entities, March, these entities are having 2017 March ending. Financial data of these entities is available with the database software, but 2016 March, last previous year was also be taken if their current financials are not available. So we have taken these financial statements of these entities because they are of the earlier previous year, and their current previous year data is not available. So only 2 years can be taken as per Rule 10 CA. And see, it's having other financial and years ending. Sorry. So this assessment year 17-18 we have undertaken. So we have got 2538, for which data of 2017 was available, or data of latest data was available of financial previous year 2015-16. Next filter is turnover filter. Turnover filter is 823 crores. Generally, it is acceptable, and through various on the basis of various judgments, 10 times less to 10 times more is the range of turnover of the entities which we can select for and filter out the other entities. So 10 times less is 82.3 crores to 8230 crores. So these are the entities which have been accepted and having the turnover in the same range from 82.3 to 8230 crores. Next filter from 2538 we got 769. See 769 over here. Next filter next filter is trading purchase filter. If this sorry, as this is trading business entity, correct? So we can, and the financial information of the companies, they are required to give trading purchase. So we have applied trading purchase filter conservatively, that total, with respect to total purchase, they have purchased more than 75% as a trading purchase. So this filter we have applied over here. So this is percentage of trading purchases to total purchases. and we have accept our company is into wholly into trading. So we have taken this. Hello, I think. Am I audible?
Yes, sir, you are audible. Please continue, sir.
Yeah. We have taken purchase of trading goods more than 75% ratio वाले entities जो है, we have accepted and we have rejected others. So we got 447. We have written 447 over here. Next, NIC filter. So while we were accepting or selecting the companies on the basis of their industry, so they might be NIC activities might not be similar to our entity. So we have taken the NIC activities of the companies in this step, and what will be a similar to our business we have accepted, rest we have rejected. It's like this. So we have on the basis of this we have got 114 entities which are similar in NIC activities. Now next filter is plant and machinery filter. Plant and machinery filter is being into trading. The plant and machinery is not the substantial portion of total tangible assets. So we have applied the plant and machinery filter. Our entity is having, I think, 0%. Plant and machinery of our entity is 9476 with respect to this amount. That is almost 0%. So conservatively we have taken the limit to 25%. So entities having the ratio of total plant and machinery with respect to total tangible assets less than 25% have been accepted. Remaining have been rejected. Like this, 94 it's rejected, 0 has been accepted, and on this basis we have got 91 entities. Next, product wise filter. So I was discussing that in detail. Product wise filter is available in certain financial statements of the certain entities. They provide the same. So product wise database is there, like this is a entity, and we have accepted the in this filter. It's not at all necessary they will be segregating the products normally. Generally, if they are not able to segregate, they put it like this: sales operation, operating sales, sales, sale of traded goods, and these are 100% into sales. So we are not able to get exactly the exactly the product in which these entities are dealing into, correct? So we have to accept them as on conservative basis, because TNMM is applied on conservative basis. But few of them have supplied information of products or services they deal into. So this like this entity supplies 99% as revenue from sale of computer from hardware and software, and it has been rejected. 99% revenue from this. Like this is also rejected. 77% was from engineering, procurement or construction management material, and media consulting and allied services is 22. Substantially it's not working in our field trading of agro products, so we have rejected. So this is a trading purchase filter, sorry, but not trading purchase, this is a product wise filter, and 74 entities have been accepted after applying this filter. Now related party filter. Related party filter is generally it is considered that if the related party transaction is more than the 25% of total transaction from point of view of expenditure or income, revenue or cost, so it would be considered as the pricing or profitability of the entities are being controlled. That is, they might have controlled or their profitability. So these type of entities cannot be accepted as comparable entities and cannot be accepted in our search process. So like in this STC, there are, from expenditure side, we have related party expenditure is 10.87 crore, and which have been formula you can see I have applied, which is compared to total expenditure, it comes to 0.13% only. On this basis, it is acceptable, but either of the two. Here, income is 2183 crore from the related party, and 20, this is total income of the entity. When they are both are compared, so it comes to more than 25%. So either of the two, if it's more than 25%, they have, the entity is rejected, and either of but in this case we can see Central India, both of them are less than 25% expenditure side as well as income side, so they are accepted. And in certain financial statements, they are not providing the related party filters, so we used to write it accepted as RPT details or not available conservatively, we have to accept. So after applying this filter, we got 61 total comparable search. Now every type of filter has been exhausted in our search process, though one filter we can apply, that from these 61 we go to internet and search for the businesses or these entities deal into, and on that basis, if they are in dealing into same or similar product, we accept or reject. Like this, we have rejected as it's an investment company, so this company is, we have taken we also rejected this because it's into different products, but this company we have accepted because this is dealing into agro products, agro trading into products. So this, we got 6 out of 61, we got, I think, 14. Accepted one is 14, yeah, 14 we got. So we have accepted at last 14 entities and applied the operating profit of this entity. So at last, now we have come to calculation of operating profit. So these 14 entities, their financial data of last 3 financial years have to be extracted. So I'm telling why these to be extracted, because range concept has to be applied in these 3, for these 3 last financial years. Range concept rule 10CA prescribes that we have to take the financials of last 3 financial years and compare them, take out their weighted average profitability. So we have, see, this is extract of our extract of the P&L, net sales, other income, total income is this. Then this is expenditure side. So these are stock adjustment, raw material, power and fuel, other manufacturing expenses till depreciation and total expenditure. And this is profit before tax. So this is we have got minus 2.4 crores. And now we will add up, we want to calculate operating profit margin. So operating profit will come when we add up the non-operating expenses and deduct non-operating income. So non-operating expenses would be, this is segregation or bifurcation of this miscellaneous expenditure, these donation, loss, assets, loss on sale of assets, loss on sale of investment, etc. And we have taken depreciation as non-operating expenditure because this is an trading entity. So total non-operating expenditure is this much. You can see the formula how it is applied. Total expenditure of this is total, and this is 2.99, and total of non-operating is this much. This we have taken this as it is because every income which is reported under this heading in the software is non-operating only. So we got operating profit, that is profit before tax plus non-operating expense minus non-operating income is the we get operating profit, and we have applied this in all the columns, and we have got operating revenue. This is the same as net sales over here, and operating cost is the cost, this total cost minus this total non-operating expenditure. So this is operating cost. Then as per rule 10CA, we have to take aggregate of all these, and we have to take aggregate of operating profit, operating revenue. Though our PLI is operating profit to operating revenue, correct? So still we are taking operating cost into play. Suppose if the TPO doesn't want to apply that operating revenue, then it's easily available at the hand in the operating cost PLI. So we have to aggregate, and this is the weighted average we have got of the this comparable weighted average percentage of operating profit to operating revenue, and this is with respect to operating cost. So we got all the weighted averages of all the entities. We have selected 14 entities, and now we will come to next step, that is we have got our computation of our assessees operating profit. So we have same concept we have applied. These are non-operating expenditures, these are non-operating incomes, and we have deducted this from total expenditure, deducted this from total income, and then we have got operating profit, operating income, and operating costs. So these are the operating profit margins of our assessee. Sorry, tested party, not the assessee, the tested party which we have taken. Now we have got these margins. We have arranged these margins like this, all the margins we have got, and now with this is with respect to operating revenue, this is with respect to operating cost. So we have got these margins. We have, as per rule 10CA, we have to arrange all these margins, weighted average margins, into ascending order, and take out the range, the arm's length range, and our tested entities range profitability should lie in that range, or should be more. If it's Indian entity, then it's acceptable. If it's more than the range, the profitability. So we got the profitability margins. Now the range is the 35th percentile to 65th percentile of total number of comparable entities. So total are 14. So 35th percentile is 4.9. So 4.9 is not a whole number. So next whole number we have to take, that is 5, and 0.54 is the starting margin. Margin starts, and 65th percentile of 14 is 9.1. So 9.1 is not whole number. Next one we have to take as per rule 10CA, that is 10. We don't have to round it off. We have to take the next whole number. This is not a rounding off. This is as per rules 10CA. So next whole number is 10, and the range ends. So arm's length range comes to 0.54 to 1.47, and our entity's margin is much higher. That means the entity is having much more profitability than the comparable companies operating into the industry, and that means the profitability has not been transferred, or profit that should be in India, should remain in India, has remained in India and has not been transferred to any other tax jurisdiction or any other country. So this is the conclusion and range concept we have applied. Now if we go to TPO will not accept negative figures, negative margins. So we have applied for, this was prepared for a assessment only. So this we have applied. We have reduced these 3 and taken 11 remaining. 11 ka 35th percentile is 3.85, and next whole number is 4. So it comes to 0.65, and 65th percentile is 7.15, and it comes to 1.88. So 8 is the next whole number, and 1.88. So if we compare this range also, we are far ahead, or our margin is far ahead from the range, excluding the negative range. So this is the basic transfer pricing search process we have discussed of a trading company. Uh, in respect of a trading company, and I'll just go through certain industry specific filters. These filters we can apply to the incomparable search process, which are RPT abnormal profit. Abnormal profit filter is like we were having a profitability or abnormal loss per filter, but the loss or profit are abnormal, like 60%, 40%, or for more than that, or 30%. It depends on circumstances. And see, transfer pricing is very subjective in nature. हमने ये we have done this comparable search, or but at our end, that TPO will do it at his end, and then we will approach, or we will come at conclusion. So this is from our end, but from TPO end it is very subjective. So abnormal loss or abnormal profit is also subjective. Like for trading concerns, 20% or 30% would be abnormal profit or loss, but for IT companies it can be a normal profit or loss, correct? So next is specific filters, industry specific filters. We can say our trading purchase filter, which we have seen, export turnover. If a company is into export, so export turnover to total turnover, 100% export. So more conservatively, we normally take 75% or more filters, correct? And export turnover can be inversely used. That is import, if a country is only importing or selling, having sales into domestic market, so less than 25% can be taken export turnover to total turnover. That can be a filter. Fixed asset based filter we have taken, already seen in our example, trading business. Newly incorporated and has, this is one of the specific filter we can apply, that the company has been recently incorporated, IT company incorporated last year, and has very less profitability. So we cannot compare the profitability of that company with the companies which were incorporated much earlier to than that. We have to compare the profitability with the companies which have been incorporated in that previous year, or max to max earlier previous year, so that it's in the profit comparison is justified. Now rule 10 CA, few points I have written over here, prescribed the range concept. So in our example, we got 14 entities. Suppose if we got 5 entities only, then we would not taken 3 years financial statements. Even we would have taken, we have to take only latest financial statements, and take the average mean normal average of those entities profitability, and not the weighted average as we have compared. So that has been prescribed under rule 10 CA, that if the comparable entities are 6 or more, then only range concept would apply, else normal mean, arithmetic mean would be applicable. And range concept is determined, range of PLI selected to determine considered as arm's length range. And this we have discussed, that has set 35th percentile and 65th percentile for weighted average margins of last 3 financial years we have to consider, and we have taken that into in our illustration, correct? Now this is transfer pricing penal provisions. So these are the penal provisions or penalties which are applicable to the assessees. These are not covering the master file and country by country penal provisions. It's only considering the non-compliance of Form 3CB, TP audit report, and the non-reporting or under-reporting of the international transaction, erroneous reporting of the international transaction, and specified domestic transactions into the 3CEB plus non-compliance with respect to section 92D read with rule 10D, that is the documentation, the TP study report which we have discussed, that has to be maintained because that is the base of transfer pricing audit. For it has to be done before we conduct or finalize the audit, because audit depends on the method applied and methods has to be justified through the documentation. So friends and dear professional colleagues, this was for today's webinar, and hope you uh, got something or you have learned, or I have learned a lot because of preparing this presentation. And now a dividend question I have asked, whether it is an international transaction or not. So international transaction, so dividend is not considered as international transaction because it's a mere appropriation of profit and not affecting any asset, profit, income or revenue of the company or assessee. So dividend by subsidiary, Indian subsidiary to US holding subsidiary is not to be considered as an international transaction, need not be reported into the 3CEB, Form 3CEB, and into the documentation cannot be taken as a documentation process. So that's for all today. Hope you can be safe and in safe zone, and take care of everything around you, all the family members. Over to you.
Thank you, Chaitanya ji. Wonderful presentation. And we have a run poll and we got a wonderful feedback from participants. About 80% are extremely satisfied, moderately satisfied with the presentation, with the webinar, and solve your, question, all the question. We are very thankful to you, sir.
Okay, thanks a lot, Virag. And these queries have to be resolved now, or we will in group you will resolve.
Which query? Anything fine, sir. Right now also okay, but few member may be left, so we can have in a group that will be better.
Okay. So friends, this was the presentation basis on my experience and exposure to transfer pricing, and I'll now explain the queries on the or give the answers. Charging section 92 is about any income. What if there is an expense transaction between the AE? Will transfer pricing attract? Zayan Kakajiwala. Yes, Zayan, I have covered this, that section 92 asks about income, but further then section 92A, 92B defines international transaction and AEs. So they have to be considered, and conservatively this can be argued, but we have to comply with the requirements under transfer pricing. Expense would be covered as international transaction. So Mr. Rakesh Jain, if it is 25% holding and the person is also not director in AE, so 25% holding is not the criteria for AE. AE has 26% or more criteria, so it will not be considered as AE. Then again, Zayan has asked, more than 50% of the BOD is appointing is appointing ED of two different companies, then those two different companies are deemed to be A. More than 50% of BOD of one entity is appointing executive director of two different companies. Yes, if it is justified that that entity or management of that entity is involved in appointing the management or executive directors of the other entities, then they would be considered as A's. Next is Sandeep Kamath. Sir, Sandeep ji has written, suppose there are two entities, that is A and B. A is a global company which procures vast software development business and outsources the same to company B in India for a fee plus an margin on cost. Will transfer pricing be applicable? The global company which procures vast software development business and not outsources the same to company B in India. Will transfer pricing be applicable? The company B exclusively work for company A. The relation between two enterprises, common employee in the, yes, AE's establishment is there because it is the Indian entity is wholly dependent on the company B, which is the mainly outsourcing the business. Sorry. So the AE relationship is established. Whole business is dependent on the other enterprise. This was very good question, and this question is still arguable because there are the clauses talk about raw material and all, not for the services. So, but conservatively, AE's relationship is established. Ankit Shah has asked, is share capital is covered in list of transaction and hence required to be, it's not. Hello Virag.
Sir.
हाँ, ये few questions I am unable to see, तो उनको ग्रुप पे मैसेज करने का बोलिए ना, अंकित शाह.
हाँ, ग्रुप में कर देंगे सर, ग्रुप में करेंगे.
हाँ, ग्रुप में करें तो ज्यादा बेटर रहेगा. So
हाँ, yes,
I will,
yes, ग्रुप में करते हैं.
because time is constraint is there. I think correct.
Sir, it's already more than around 1:15. We should close, sir.
There are various other questions. So whether these can be taken or copied to the group or what exactly?
नहीं सर, वो वहाँ पे वापस पूछ लेंगे और I will mail you, sir.
The record is with us, correct? Queries record.
Sir, yes.
Just send me the queries, so I'll reply to all of them.
Sure, sir, sure.
Okay, Virag. Thanks a lot, everyone.
Thank you,
Take care.
sir. Yes, we are ending it.